Hello and welcome to the Invest with Rules midweek update. My name is Scott Bennett, joined by Mike Olafson. It's the 23rd of October. Welcome. We have a really fun and jam-packed agenda for you. Let me dive right in. What we're going to cover today with you is Goldman Sachs came out with an article titled "A Decade of Big S&P 500 Gains is Over," according to them. We're going to dive through that. What does that really mean? And then we're also going to look at how the trend roadmap navigated the more recent lost decade. So we're going to look through that and a whole lot more. Before we do, world's quickest disclosure: this is just information, not a direct solicitation to go buy or sell anything. Please always manage your risk, manage your stops. There's a manage your financial plan. There's a lot of risk out there, so please do that. Okay, before we dive in, how we run everything through our process, we're going to look at what's called the trend roadmap. There are four distinct stages, and then we're going to really filter everything through the Invest with Rules trends and signaling process, which helps us stay on the right side of the trend. So if one is more of a, think of shorter term trader, this is where one would, in essence, enter on U-turn signals, which we'll get into more in a moment, and one would kind of peel out or exit out on stage 3 topping pattern known as coast signals. If one is more of a long-term investor, this is where one could, in essence, enter on stage 1 or fully on stage 2, which is these gas signals where we kind of hit the gas, like think driving a car. And then we really want to try our hardest to avoid stage 4 declines. We'll call that a break signal. And very simply, these signals are all over our information. They're over our live sheet, and that helps us stay kind of focused to follow the trend. So before I dive into today's kind of in-depth content, what I want to share with you is we've had situations in the past. I know it's hard to think through it, kind of mentally compartmentalize it as we are in a really strong bull market, but there have been multiple decades where the stock market has just simply moved sideways and not performed. So if one is saving for retirement, typically this isn't as detrimental. But if one is retired and withdrawing money, that's a totally different story. So you'll see the very first one in the World War I influenza, kind of a decade plus of moving sideways. You had one in the 1929 crash after the Roaring '20s. We had one with the inflation in the 1970s, and then more recently, the dot-com top, followed by a lost decade. So we'll zoom in on more recently the 1970s. This was 1979 through 1968. The market went nowhere. If we look at more recently the 2000 through 2009, which we're going to dive through a lot more in this video, the blue line, the S&P 500, did not make money. Started with $1 million. A whole decade later, you haven't made any progress. If one would have simply just stayed in cash or T-bills, you would have done way better. So not saying this is happening in the future, but this kind of brings us to kind of how this could be possible. So this is the Shiller PE ratio analysis. This is Robert Shiller, a professor at Yale. And very simply, you have all the way back to the 1880s till more recently. And this PE ratio, the price to earnings ratio, the question is the market expensive or is it innately cheap? And right now we are at the PE ratio is 37. So if we look at the average, the mean, the median, it's roughly around between 16 and 17. So this is a more expensive market that has been really climbing nicely since the 2008 global financial crisis. Now, the question is now the time to panic and do all these things? That's why we have our trends and our signaling processes. But so far, I just want to point out, because I'm not here to spread fear, that so far the PE ratio is making what I'll call higher highs and higher lows. So now if it were to make a lower low, that would have more of my concern. But just very simply, this is not a cheap market, which then brings us to the article from Goldman Sachs. And very simply what they're saying this past week, and I have the article linked for members to grab that link, and then if you want to really read more in depth. But the S&P 500, according to Goldman Sachs, is expected to post annualized nominal total return of just 3% over the next 10 years. So obviously comparing this to the 13% in the last decade is a huge pullback from a performance expectation. they see a roughly 72% chance that the benchmark will actually trail treasury bonds. So stocks underperforming bonds, and a 33% likelihood that they'll lag inflation. So we go one more level deeper. Obviously, the market's done extraordinarily well. If the question then is, even with the rally to remain super concentrated, think like mega cap tech stocks, that would still post, in their opinion, a below average returns, below the kind of the norm of about 7. So overall, Goldman Sachs is saying be cautious. Mike, before we jump into our analysis on how our trend roadmap, trend and signals jump in, any comments on lost decades or Goldman Sachs's thoughts and comments?
Well, I think you said it, Scott. Nobody knows what the future is going to be, but by using something like the trend roadmap, we're preparing ourselves. And I think, as I mentioned a couple of videos ago, I'm significantly further on towards that retirement phase than you. And so this really has my attention big time because my accumulation days, my buy and hold dollar cost averaging days are pretty much behind me. And now I'm in the preservation phase. So, it really garners a lot of attention for folks like me.
Well, I appreciate that. And then do you mind sharing the Trend Roadmap 2.0 backtesting? We're going to go through long-term and short-term, and Invest with Rules, we do a
Yep.
combination of both, but do you mind jumping into what we're looking at on the screen?
Yeah, so we decided to have a little bit of fun here, and really it's not fun, it's a serious topic, but we wanted to really kind of kick the trend roadmap in the tires and see if it held up to the lost decade from the 2000s. As I think many of you know, especially the members know, we did really well in the last bear market 2022, and it held up really well. So we want to make sure the trend roadmap would hold up even during a longer phase of bear market. So we go back to the last decade of 2000 to 2010. Now we had to adjust this as a kind of a little bit of setup to the back testing here because our data only goes back about 22, 23 years, we had to adjust it through from mid 2001 through mid 2011. So almost the same time frame. Basically, the S&P, as you can see from the chart, going nowhere. Now, the chart itself shows you the yellow line, kind of yellow orange line is the S&P 500. The blue line is the equity curve using the long-term signals for the trend roadmap. So basically buying on gas or entering on gas, exiting on break. So let me kind of, with that setup, let me give you some high. Oh, and by the way, I should mention that this includes level one, QQQ, SPY, and IWM. Does not include VEU because VEU came out in 2007. So we excluded that from the backtest. So basically the way the backtest is we got $1 million portfolio. We're adding 3 positions, up to 3 positions, these 3 tickers in equal weights of 33% each. So let's go through some of the results. The chart speaks, I think, volumes as far as what happened visually, but specifically where the S&P went nowhere, the results of the trend roadmap backtest yielded a over 6% average annual return. So basically, as the S&P was going nowhere, you were making roughly on average 6% a year. Now, is that the 11+% we're used to these days? No, but it's a heck of a lot better than your money going nowhere, especially if you're trying to live off of it. And in fact, if you use that CFP rule of thumb of living off about 4% of your investments each year, think about it. You're making 6, you're living off 4. You're actually still preserving or adding to your capital with that variance between the 6 and the 4%. And then a couple of the highlights to just mention to you is this is without a huge amount of trading. So if you look in kind of, I know it's an eye chart, but in the middle lower part of the chart, we were averaging about 7 trades a year with this strategy. So less than 1 a month. Not too bad and pretty darn easy. Last highlight I'll make for you in the lower right-hand corner, that eye chart talks about year by year how we did with the trend roadmap versus the S&P 500. And I highlighted 2 years. You can see 2002 and then again in 2008. not only did we vastly beat the S&P, but we were in cash for a good chunk of the time. Anytime you see a zero in that performance chart, and by the way, everybody's going to get a copy of these slides, all the members will, so you can take a look at it in detail. But anytime you see a zero, that's when we were in cash. So the long-term signal protected us and kept us in cash. Any comments, Scott, before we move to short term?
Yes, a couple of things that stick out to me. This is a back test from a website called Market In Out, which is the
Thank you. Yes. Yep.
third-party back testing software that we pay for. There's no affiliation. I just think what stands out to me and for me and my family is 2008 was when I was working face to face with high net worth families at Fidelity. And I remember that pretty clearly when families would come in. I have like 7 appointments a day. My phone would have like dozens of messages. This is when the panic starts. The question is, would you panic instead of being down? Like, I know at the end of the year, it kind of snapped back, but at one point it was down 50% in 2008. But if you were down 10%, would that have had you call your advisor and politely lose your mind a little bit? Not you, but globally, sell out at the absolute worst time? Because I think that's something that happens is people tend to hit the get me out of this, end the pain at the usually at the absolute low at the worst time. But if it was a pullback of single digits and or 10%, and this doesn't include any hedging, which we do in our strategy. This is just tech stocks, S&P 500, and small caps equally weighted. Granted, it would have gone to cash, but it's not hedging in any capacity. So
Mhm.
the question is could you have slept at night having this pullback in both of these scenarios, knowing that you're not getting like steamrolled by, I would say, the banks lending to people that couldn't pay their mortgages inappropriately. So this has very minimal to no effect on you. So I'll turn it back to you, Mike.
Yeah, in fact, just to underline something you said, just to put fine numbers on it, the maximum drawdown, meaning from peak to low for the S&P 500 was 57%. That's massive. Imagine losing that much of your nest egg. The maximum drawdown of the long-term signals for the trend roadmap was 19%. I don't know about the folks out there in my situation, but I could live with 19%. 57% would have me panic to Scott's point.
Yeah,
Well, I'll tell you what, let's go. Yeah, yeah. I'm sorry. Go ahead.
go to the next one.
Yeah, yeah, definitely. So we can make this a bit quicker because we've already kind of done the setup, same type of setup, same ticker, same time frame, same $1 million, etc. And except this is using the short-term signals of TR 2.0, meaning that we're entering on a U-turn, we're exiting on a coast. So what that produces, the returns are not quite as good because what's happening is because it's a short-term signal, the model's got us stepping up to the plate to try to take a hit, several more times, a lot more times than the long-term signal. But the results really aren't too shabby when you think about it. So the ultimate result for this short-term method was well over 3% average return per year. Once again, not stellar returns, but certainly better than going nowhere with the S&P 500 buy and hold. Now, here's another interesting thing. The max drawdown for the short term, as you might expect, was heavier. So instead of 19%, in this case, it was in the 30s, but still a heck of a lot better than the 57% drawdown that the S&P 500 had. And the last thing I'll mention before I flip it back to Scott is when you combine both these, so say we started in 2001, the full trend roadmap strategy with the short and long-term signals, we would have averaged about a 4.8% return per year, about a 25.7% drawdown. Once again, manageable, heck of a lot better than 57%. And ultimately, we would have made over 50% more in totality in our nest egg using this method than buy and hold, which went nowhere.
Yes.
Scott, thoughts
I
to wrap
would
it up?
I would wrap this up with a comment that using the U-turn to coast, so think shorter term trader, in our process, we would deploy half of the capital. In this example, we said full just because we're trying to make this as simple as possible. But so we're not like after a huge bear market, this is when these U-turns show up for these major indexes. And that's where we would start with half and then go to full positions on gas signal. So again,
Yep.
the hit on the short term would be substantially less, and the hit would be substantially less because of using hedging. So, meaning buying things that would go up when the market goes down to protect ourselves. So, overall, we're showing you a very kind of a simple, clean version of this back test, but there's always nuance to all of it, and with with application that we do. And then the other thing I would simply say is this just globally is the difference between for someone in retirement running out of money or not. This is the difference between leaving a legacy or not. And I always think like for me, why did we build all this? Like, why did I build this for me and my family? Why is Mike dedicated a lot of his time to all of this as being a part of this? It's just very simply, I personally need these signals and trends. I need them. They're part of my arsenal of how to invest and how to protect, because protecting is just as important as making it. It's kind of growing and preserving. So I always kind of think of like you meaning thank you for being a member, like a listener, just what if you really just stripped out 60% of your net worth? Like how would that impact you? And I think that's really why we're all here and why we're here to make this a much smoother ride for you. That's our hope. Okay, so I'm going to move into the live sheet now. So we'll get into truly member content. So thank you for being a member. If you're not a member or you're like someone asking you lots of questions about the market, at the moment, the Inner Circle membership is it'll be open for enrollment, maybe coming up relatively soon. But right now, if one is interested, you can just go to investwithrules/waitlist and jump on. If you have questions or topics or things that you think were interesting for us to cover, hello@investwithrules.com for any questions. If you're like, this is super fun and interesting, but I just have no time. Life's busy. We totally get it. So we do this trend following big money within our advisory service called IWR Advisors, Invest with Rules Advisors. And then we do financial planning as well as a full fiduciary. So that's hello@IWR Advisors if you have any questions. Again, thank you for your time today. Mike, any final comments?
No, thanks for being a member. We really do appreciate you.
Yeah, absolutely. Enjoy your day. Talk soon. Bye bye.